Equity with Kotak AMC. Harsha, good morning. Thank you for joining us. Harsha, 15-20 days ago, there was nervousness in the market ahead of elections. FIs were selling. But right now, things are looking absolutely clear. Everyone is excited. The fact that the current government could come back into power, there seems to be a consensus. Stocks have rallied, which essentially represent infrastructure and this entire so-called policy gambit. How would you classify or how would you describe the market positioning ahead of the elections for us?
Good morning, Nikunj. As far as markets are concerned, I think, as you rightly mentioned, a couple of weeks earlier, there was quite a bit of nervousness. So to that extent, I think at least the foreign institutional players seem to be sitting on the sidelines or removing some profits from the table. But of late, we have seen, again, foreign institutional investors coming back and investing into Indian equities. Although same cannot be said about Indian domestic investors, not the institutional category, but the retail and the HNI category seem to be quite light at this point of time. However, if you look at the next 4 trading sessions, they are quite eventful. Tomorrow is expiry, day after tomorrow is deadline for MSCI rebalancing. We have exit poll results coming in before the market start on Monday. And then we have the election outcome coming the very next day. So overall, I think in the very short term, there is likely to be higher volatility. So to that extent, I would say that if you are a very, very short-term focused investor, you should not be extending yourself. But if you are investing for next couple of years and in a diversified portfolio, I think it's a good time even now to invest.
And Harsha, hi, this is Anisha also joining in the conversation. And in our ET Now CIO poll, we did post this question as to which sectors are overweight. You also participated in that. Tell us, do you believe the momentum which is there in PSUs, defense, cap goods, that's likely to continue? Or there is merit now to look at the trade which hasn't really played out, and that's private banking and the financial universe?
If you look across our portfolios, we continue to have similar overweights as we had a couple of months earlier. That is auto components, industrials, some of the other manufacturing segments. While we are more confident on the earnings stream in these particular sectors, we also recognize the fact that if you are looking at pure valuations, probably large cap private bank space is the only space that offers that comfort, because this is the only subsegment within the entire market, I would say, which is probably trading at pre-COVID valuations or even below pre-COVID valuations in some cases. So if at all you need some stability in your portfolio, you definitely need to have large cap private banks in it. So while our overall positioning on the financials is still an underweight position, but we do have significant holdings within private banks in the large cap space. Similarly, we do have a certain amount of holdings in other defensive areas such as FMCG and pharma as well, which we think will give stability to the overall portfolio. It's not that every time, every quarter, the same set of sectors are going to participate and give you returns, but you also need to keep in mind how to manage the overall portfolio volatility. So to that extent, having some of these sectors, which may not participate just because of the elections or the policy push, but definitely they need to be part of your portfolio.
Harsha, stay with us. Got a lot of analysis really coming in ahead of elections. And here's an interesting note coming in from the House of CLSA. They're talking about how 90% of the Modi stocks have outperformed on the back of policy pushed by the government. They also share their preferred list of picks. Somit is here to give us quick highlights from that note. Somit?
Well, to analyze or to get the sense of election excitement, what CLSA has done is they have analyzed the FNO universe, that is of 183 liquid stocks, and what they're seeing out of that is nearly half of the 54 companies which have are perceived as a direct beneficiary of PM Modi's policy are PSUs, and remarkably, nearly 90% of the Modi stocks have beaten the Nifty in the election-focused rally over the past 6 months, while 42% of the remaining stocks, while in the remaining half, if you see, only 42% of the stocks have outperformed. So, which means that 90% of the Modi stocks have outperformed, while 42% of the other stocks have outperformed in the last 6 months. And this may continue even going forward if there's a strong election result as per CLSA. Now, in the list, as per their analyst, L&T, ONGC, NHPC, NTPC, PFC, IGL, Mahanagar Gas, Bharti Airtel and Industars and Reliance Industries are the preferred Modi stocks as per their analysts. However, they are saying that this this narrow election theme base may end in the month of June and July, and post that in the second half of 2024 they're expecting the market narrative to change, and they are believing, or they believe, that banks have the best risk reward ratio for the second half of calendar year 2024. Now they like banks for its growths like HDFC Bank, ICICI Bank, Axis Bank and IndusInd Bank, and these four banks are already a part of CLSA's India portfolio, and they're also saying that a clear pushback on the rate cut expectations has allowed banks in US to outperform, but Indian banks, if you see on a YTD basis, especially the private banks, have continued to underperform the market. And they're also saying that their analysts continue to like Bajaj Finance, Max Financial, Zomato and DMart, also apart from the banking sector that they have just mentioned, and they're expecting that to outperform in the second half of this calendar year 2024.
Amit, a lot of food for thought. And Harsha, I want you to come in over here as well, because, you know, one of the brokerage notes, of course, is saying that 90% of the Modi stocks, that the rally is pretty much done with and behind us. How is it that you would play the PSU piece, ex-banks in specific, from here onwards?
I'm sure we do have a reasonable exposure to PSUs, but we do not classify companies based on just the ownership. We also look at the business fundamentals and the industry dynamics and then try to position ourselves. Within PSUs, we have been quite positive on the defense, entire defense piece within the PSUs. We have been holding several other stocks in the logistics, oil and gas segment, energy, power, all of these segments. So we continue to be quite positive on the entire piece at this point of time. However, the uniform rally that we saw in PSUs for a good part of 2023 may be behind us. Most of these stocks have reached valuation levels which are no more very, very attractive in that sense, or very cheap compared to historical range. So to that extent, from here on, the delivery on the business growth and profitability would be key for sustenance of these performances. But we do believe that there will be a certain set of PSUs which will continue to deliver on the higher level of business momentum, and also will be focusing on the profitability. And those are the names that we continue to hold in our portfolios.
Harsha, markets fall for whatever reason, whether it is the election outcome or whether it is global cues, that could be pure profit booking. Where would you be a buyer? Where do you think that it is time to buy the fall?
Say, if you need the stability, you need to look at large cap private sector banks and probably FMCG and pharma at this point of time. Banking, clearly, as we discussed earlier in the show, the valuations are looking quite reasonable at this point of time. So in case of a market fall, very unlikely that they would fall more than the market. And also, it's likely that they could perform, because some money could move incrementally from other places into banking. If you look at FMCG, we do believe that over the next couple of quarters, somewhere we should see a revival. It's been such an expectation for quite some time. It has not panned out. But finally, we do believe that the election spending and hopefully a reasonably strong monsoon should help FMCG to revive from here on. So that's again a sector which could give downside protection. Although in terms of valuation, same cannot be said about FMCG, as we spoken about large cap banks, because the valuations have not corrected in absolute terms, but there has been a reasonable time correction over the last several quarters. So to that extent, that also offers downside support, I would say. And then pharma, it's not a top-down call, but there are certain pharma companies on a bottom-up basis which are still delivering good numbers, and they are unlikely to be as volatile as rest of the markets. And also, if you look at purely from a short-term performance perspective, as you rightly mentioned, some of the policy beneficiaries or likely beneficiaries have done much better than some of these defensive segments. So there is going to be a little bit of stability in these three pockets.
Harsha, are you churning your overweights, underweights a bit? Because it seems like there are select people who are booking out a bit out of automobiles and putting it in sectors like chemicals, etc. Anything that you are doing?
Nothing on the larger side, I would say. There would be a little bit of profit booking here and there across many sectors. That would be specific to individual portfolios. But across the fund house, we have not taken a call in terms of trimming any large overweight position into a underweight position or vice versa. But yes, autos have done quite well. So there could be an inclination to book some profits in some subsegments of auto. But at this point of time, we do believe that two-wheelers as well as auto components will continue to deliver numbers on earnings growth. If you look at financial year 24 and 25, 24 we have already seen where these companies have delivered good numbers, and 25 and 26 as well. You are likely to see better than market average earnings growth from this pocket. So to that extent, while valuations may look slightly higher than what we had seen a couple of quarters back, we do believe that over the next couple of years, this segment will remain an outperformer in the overall portfolio.
Okay. All right, Harsha, really appreciate your time. Thank you. Could join us.